Hi, I'm Joly. This is my channel, China's New Playbook. In our last report, we ripped open the hood of the Chinese industrial machine, analyzing how its physical component transit and coordination cycles compress the physical supply chain. But if you only view China as a heavy, asset-intensive manufacturing factory, you are missing the most lucrative dimension of the current venture cycle. Today, we flip the coin. We're going to dissect the intellectual property and soft power arbitrage running over this physical engine. The transition from exporting physical weight to exporting pure intellectual velocity. The conventional consensus among Western risk committees is that, while Chinese firms excel at low-cost processing, they fundamentally lack the capability to build high-margin brand equity, capture complex intellectual property premiums, or navigate non-domestic regulatory compliance. They assume Chinese tech is structurally trapped in the low-margin basement of global trade. But if you look at empirical economic research, this narrative is being thoroughly dismantled. Today, we drop the speculation. We're going to look at the exact academic and institutional data tracking how the new generation of VC-backed founders is using China's physical infrastructure to underwrite global intellectual dominance and analyze the two specific verticals where sophisticated GPs are capturing pure structural alpha. To understand the mechanics of this intellectual arbitrage, we must look at how proximity to physical manufacturing directly accelerates proprietary software and algorithmic IP development. In traditional technology clusters like Silicon Valley, hardware manufacturing and software engineering operate in separate geographic silos. When a frontier hardware startup designs an IP-intensive robotics or automation device, the physical separation from the manufacturing base creates an extended feedback loop. The empirical proof of this friction was mapped in a landmark book by the MIT production in the Innovation Economy Commission, titled Making in America: From Innovation to Market. The research demonstrated that when the R&D team is geographically decoupled from the production floor, the time required to diagnose design flaws, re-engineer components, and redeploy system firmware creates a massive operational drag. In the Chuhai 2.0 master play, Chinese deep tech startups eliminate this drag through what academic researchers define as industrial co-location. According to a podcast published in the Harvard Business Review by Professor Gary Pisano, titled Restoring America's Competitiveness, by integrating software and system engineers directly into high-density industrial ecosystems of Shenzhen or the Yangtze River Delta, the cycle of translating digital algorithmic adjustments into physical product iterations is accelerated exponentially. The physical asset-heavy risk and infrastructure costs are absorbed onshore by domestic supply chains, while the global margin is extracted via asset-light, proprietary intellectual property deployed offshore in premium markets. It is a continuous, software-driven feedback loop running at physical speed. Vertical 1. Spatial Intelligence, Navigation Algorithm, or Edge AI. The first specific investment verticals where this intellectual arbitrage is generating institutional-grade returns is industrial edge AI or autonomous spatial intelligence platforms. We do not back generic manufacturing. We invest in the proprietary software brains, specifically SLAM, simultaneous localization and mapping, and fleet orchestration algorithms that run over globally commoditized automation hardware. According to the World Intellectual Property Organization, WIPO, Patent Landscape Report on Generative Artificial Intelligence, between 2014 and 2023, China has emerged as a dominant force in AI innovation, producing over 38,000 patent families, 6 times more than the United States. This extensive algorithmic intellectual property is heavily concentrated in edge computing navigation and multi-agent robotic coordination algorithms. The soft power arbitrage here is driven by 2 documented realities. Number 1, the empirical data loop. Because China has deployed the world's most high-density automated port and warehouse infrastructures, local software teams have immediate access to massive, complex operational datasets. This dense operational volume allows local AI models to train on real-world edge cases at a scale that offshore competitors cannot replicate. Number 2, the R&D labor cost asymmetry. The empirical proof of this talent advantage is tracking in the National Science Foundation's Science and Engineering Indicators report, which confirms that China's continuous output of STEM and precision machining professionals has structurally surpassed the United States and the European Union. Furthermore, corporate research from Goldman Sachs Global Investment Research confirms that this extreme technical density suppresses the average fully loaded R&D cost per iteration for algorithmic startups to roughly 15 to 25% of Silicon Valley baselines. When our portfolio companies sign enterprise contracts with fulfillment centers or container terminals in Western Europe or the Middle East, they are not exporting steel. They are deploying proprietary high-margin software licenses and AI-native system integration over a commoditized hardware layer. They capture global dollar cash flows with the gross margin profile of an asset-light software business. Vertical 2. Globalized digital IP and algorithmic commerce infrastructure. The second vertical where this soft power arbitrage is rewriting the playbook is globalized digital content IP and algorithmic commerce platforms. For years, mainstream Western allocators believed that Chinese consumer internet opportunities were entirely extinguished by domestic regulatory corrections. That framework is obsolete. The old play of scaling domestic consumer traffic is dead, but a new play is exporting sophisticated algorithmic infrastructure and localized digital IP internationally. According to the United Nations Conference on Trade and Development, UNCTAD, Digital Economy Database, and a collaborative handbook on measuring digital trade, digitally delivered services have transformed into the fastest growing segment of international commerce. Globally, this asset-light digital trade expansion has commanded over 50% of all global services exports. The empirical data tracks a structural geographical shift, showing that digital infrastructure and programmatic platforms expanding out of the Indo-Pacific region are constantly outpacing traditional merchandise trade growth. The elite VC-backed teams in this space are executing what Harvard Business School corporate strategy research defined as a decoupled corporate structure. This model is being successfully deployed across micro-entertainment platforms, interactive gaming IP, and AI-native design software. These companies utilize the deep, cost-efficient technical talent pool onshore to build the underlying algorithmic models, process data, and execute rapid software features. Simultaneously, they establish completely autonomous corporate headquarters in premium jurisdictions like Singapore, London, or Silicon Valley to handle localized user acquisition, brand marketing, and strict compliance with local data protection laws like GDPR and CCPA. They are not competing on low-cost labor. They are competing on the velocity of digital curation. They capture high lifetime value, LTV, international consumers paying in premium currencies, while keeping their operational cost baseline tethered to a highly optimized technical engine. The strategic conclusion for global asset allocators is absolute. Writing off China based on superficial manufacturing headlines means you're blind to the high-margin digital software and IP layer being built directly on top of that physical infrastructure. The manufacturing engine is merely the foundation. The real offer is in the intellectual code running over it. To secure hard DPI in this new cycle, your portfolio must pivot away from asset-heavy manufacturing risks and aggressively underwrite technology-driven, asset-light innovation that possesses the soft power to scale internationally. Now, mastering this intellectual and soft power arbitrage forms the high-margin core of the new playbook. But how do top-tier managers actually execute this transition operationally without running into capital control gridlock or cross-border compliance friction? In our upcoming reports, we're going to dive straight into the actual underground execution blueprints. We will break down the exact financial engineering, QFLP network structures, and localized capital alignments that allow global LPs to move capital cleanly and secure hard distributions. But before we get tactical, I want to hear your thesis in the comments. Does your asset allocation committee still view Chinese technology purely through the lens of hardware manufacturing? Or are you hunting for high-margin software and IP arbitrage? Drop your institutional experience below. I read and reply to every inquiry. If you are a fund manager, a family office executive, or an allocator trying to read the real signals in China's private markets, hit subscribe. And let's figure out this new paradigm together. Thanks for watching, and I'll see you in the next report.